Today, we're delighted to have Professor Joe Pagliari, Clinical Professor of Real Estate at Chicago Booth, to discuss the state of the U.S. commercial real estate market with Green Street Senior Advisor to the research team, Jim Sullivan. Today's webinar will last 1 hour with 45 minutes for our panelists and 15 minutes for Q&A. Thank you to those of you who submitted questions to our speakers in advance. We will be asking those questions first, and then any additional questions that come through the Q&A function, time permitting. Without further ado, I will pass along to Professor Pagliari to kick us off.
Okay, well, thank you very much, everyone, for attending, and thank you especially to Jim for joining us and hosting what I'm sure will be a very interesting and insightful presentation. And so, Jim, let me just turn it over to you, and I'll advance the slides as you request me to do so. Okay?
Great, thanks. And hello, everybody, and thanks for the invitation to be here today. My name is Jim Sullivan. I work at a firm called Green Street Advisors, where I've been for 26 years. And if you don't know Green Street, we're an investment research firm. We specialize in commercial real estate. And I think the value that I bring today is that we look at real estate from two angles. We look at the public world, which is comprised primarily of real estate investment trusts, and then the private real estate world, which is comprised of a variety of different types of institutional investors, many of whom are on this call today. So what we're going to talk about during this presentation is just the state of the commercial real estate industry in the US. We'll talk about some of the key drivers, things like COVID and work from home, fiscal health across different municipalities and states, and how those are affecting the demand for real estate, the value for real estate, and I'll be happy to answer questions along the way. I do want to thank, before we get started, my colleague, Stephen Pisano. He's on the call. He prepared these slides. I have gray hair, so putting this kind of information together is quite challenging. For Stephen, it's less challenging. He's an expert at it, and I want to thank him for the hard work he did putting this together. So with that, Joe, why don't we go to the first slide? All right, so we're here to talk about commercial real estate, which sounds pretty simple, but when we talk about commercial real estate, what are we even talking about? And I know some people on the call are commercial real estate experts. I think some other people on the call are casual observers. But what this slide shows is the equity market cap by property type for the different REITs here in the United States. And if you go to the left of the exhibit and you think back to the year 2000 and you think about, okay, what kind of property types were REITs invested in back in 2000? You'll see that what we call traditional property types represented about 80% of the industry. So retail, which includes malls and grocery anchored shopping centers, office, residential, which means apartments, and industrial, which means warehouse properties. Those traditional real estate property types comprised about 80% of the REIT industry. And I should note that REITs in the US tend to specialize by property type. They tend to own one kind of property type. So we can talk about office REITs, apartment REITs, hotel REITs. So that was the state of the world in 2000. And then when you look to the right side of the screen here, you see some unfamiliar names. So down at the bottom, tower REITs and data center REITs and net lease and gaming REITs. In 2000, these were zeros, and today, collectively, they represent 35% of our entire REIT industry. So when we talk about commercial real estate, most people will still talk about the traditional property types, retail, office, apartments, and industrial. Some people might throw hotels into traditional, but when you look at retail, for example, and you see how enormously important retail used to be and how tiny it is today, it just speaks to how real estate has evolved, that some of these traditional property types just aren't nearly as important as they used to be. And there's some emerging property types, which is where a lot of the capital wants to go. And some of the names that you don't see on here are life sciences, which are office buildings that are specialized for life science tenants. A single family rental, which 10 years ago was a mom and pop industry, and today is attracting enormous amounts of real estate capital. Marinas, we saw a $2 billion marina acquisition very recently by one of the public REITs. And when we talk about real estate, what are we talking about is an interesting place to start. And I think you have some people that are kind of wedded into the old way, and you have a lot of people who are making a lot of money looking to where the industry is going rather than to where it's been. Next slide, Joe. So now let's talk about how real estate has performed. And again, with REITs, you have all these property specializations. So you can really look across different property types to see how things have gone during the 7 months, the 8 months that we've been dealing with COVID. So what this chart shows is how these different property types have performed in the public market, these REITs that are traded on the New York Stock Exchange, since February 21st, the peak of the stock market. And what you see are some dark green bars. Let's start with the light green bars. The light green bars are changes in share price. But REITs use a lot of debt. Some use more, some use less. And so to us, the dark green bars, which are the unlevered implied values that the public market is ascribing to these different property types, is a better place to look. So said differently, light green is share price changes. Dark green is what the public market, what REIT investors are saying these property types have changed in value. And you see some pretty enormous, largely negative values since the peak of the market in February, on February the 21st. And when you look at some of the names on the left, the relative winners, data centers, self-storage, cold storage warehouses, towers, industrial, these are all property types where if you think through it and you think through it from a demand standpoint, have held up relatively well in an economic downturn and a work from home kind of world. And on the right, you see the relative losers. So office in a work from home environment, malls in a shop from home retailer bankruptcy world, and lodging, the hotel REITs, where a bunch of their properties early on in COVID literally were closed for business. So it's not surprising to see some of these relative valuations. Next slide, Joe. And so this chart tells a similar story, but it's dated March 23rd, which was the trough in the stock market. And again, this is a way of saying, okay, as the dust began to settle and we started to sort things out, and we could figure out, at least guess at where things were going to be okay and where they would not be okay. Again, you see the names on the left, the relative winners, self-storage, urban millennials moving out of their apartments to move home with mom and dad and storing their goods. Industrial, turbocharged by e-commerce and e-commerce demand. SFR is single family rental. I'm moving out of my apartment. I'm going to work from home. I need more space for me and my kids. Instead of renting a tiny apartment, I'm going to move to the suburbs and rent a house. That's performed well. Data centers, these buildings that are filled with server equipment instead of people, have fared well as they generate the means by which we can do calls like this. And then going to the right, you see some names that aren't surprising. We use this odd name, strip centers. That's for the uninitiated. Strip centers are grocery anchored shopping centers. They've done poorly. Malls have done poorly in a shop from home environment. And then office has done particularly poorly. And the future of the office business is a place where there is incredible difference of opinion and debate. But again, this shows since the trough, we've had a big recovery in the public market, but it's been uneven, and the relative winners and losers have been sorted out. Joe, next slide. All right, so bear with me. There's a lot going on in this slide, but it's important. So at Green Street, our pricing, a basic question that we try to ask for institutional portfolio managers, mutual fund portfolio managers, sovereign wealth funds, hedge funds, is, are REITs cheap or not relative to other places I can put my capital? And within REITs, who's cheap and who's expensive? And in doing that, the foundation of our pricing model is what's the market value of the real estate. So these real estate companies own large portfolios of real estate that are attached to, in most cases, management teams that are good to best in class, supported by balance sheets that tend to be conservatively managed. And as an investor, you should be willing to pay the value of the real estate, maybe a little premium for the quality of the management team. You certainly want to pay a premium for liquidity, which you get in the public market that you don't get in the private market. But add all that together, and REITs should trade at premiums to the market value of their assets of about 5% or so. And over 30 years, REITs have traded on average at premiums to the market value of their real estate of about 5%. Here's where we stand today across these different property types. You have REITs that are trading at enormous premiums to the market value of their assets, towers and data centers and cold storage at the top of the list. And then you have other property types that are trading at giant discounts to the market value of their assets. Grocery anchored shopping centers, hotels, and office down at the bottom. This is important because the public market has a really good track record for predicting where private market prices are going to be a year from now. And many more times than not, when REITs trade at big premiums to the market value of their assets, a year later, prices in the private market are higher. And way more often than not, when REITs trade at big discounts to the market value of their assets, a year later, private market values are lower than they were a year prior. So even if you're in the private real estate world and you don't have any intersection with REITs, this is a chart you should pay attention to, because if I had to bet what data center prices in the private market are going to be a year from now, this is a off the chart strong signal that data center values will be higher a year from now. And conversely, this is an off the chart signal in office that office values are going to be lower a year from now. Now, within that comment, you need to talk about geography, you need to talk about the specific asset, you have to talk about its age, you have to talk about its tenants. But this is a great place to start the betting, and then to force you to ask those types of questions to hone in how confident you are or not making those bets. Next slide, Joe. All right, work from home. Work from home, as the header says, is a game changer. And bear with me on the bottom left here. I want to walk you through this. So the light green bars here, so what we're trying to show here is for people who have office types of jobs, office using types of jobs, pre-COVID, how many worked from home and how often did they work from home? And these light green bars are Bureau of Labor Statistics figures. And what you see here is that pre-COVID, the vast majority of office type using jobs and people who had those jobs never worked from home, almost 90%. And then you had a small group that worked a couple of days a week at home. You had a similar sized group that worked 3 or 4 days at home, and then the other day or two in the office. And then you had this very small group that always worked from home. These dark green bars are Green Street's prediction as to how that's going to change going forward. And while I think there are some folks that are saying, gee, you know, everybody's going to work from home and they're never going to be in the office again, we certainly don't subscribe to that thesis. Our view is that the majority of workers will continue to always work from the office. But an important and much larger group of people than in the past will work a couple of days at home, 3 to 4 days at home, and then a meaningful number of people will always work from home, but it's still 10% of the total. So office is not going away, but when you add up 1 to 2 days a week, 3 to 4 days a week, or always, that's a pretty big blow to office demand. And when you go to the right on this exhibit and we think about work from home winners and losers in these different property types, you see on the bottom left, office is a big loser. Single family rental, I'm working from home, I need more space. Towers, someone asked, what's a tower? These are companies that own cell towers. There's 3 giant REITs that own together 80% of all the cell towers in the United States. So when we talk about towers, these are REITs that own cell towers. And just as an aside, there are a lot of people in the real estate industry that say, hey, towers aren't really real estate. They're pieces of communication infrastructure that the IRS said was real estate for purposes of these companies, which used to be publicly traded C Corps, converting to real estate investment trusts and therefore not having to pay corporate income tax. Some traditional real estate people would say towers are not real estate, and hence the debate, what is real estate? At Green Street, we're much more open-minded than that. It's an inherently permanent structure generating cash flow. And as an investor, my responsibility to my clients, to my partners, is to find the best risk-adjusted returns I can get in real estate. And so tell me about the cash flow, tell me about the growth and risk characteristics, tell me about obsolescence risks and things like that, and I'll tell you whether I like towers more than single-family rental, more than office, more than hotels. But anyway, this is I think it's an important way when we ask the question, hey, how is work from home going to affect the real estate market? You got to start on the left and have some guesses at some of these numbers, and then you can move to the right and think about who are the relative winners, who are the relative losers. Next slide, Joe. All right, so we talked about work from home. Now let's talk about fiscal instability. So some of the data on this chart is actually quite dated, but that's okay because the trends I'm going to describe are only accelerating from where we were 16, 17, 18. So what this chart shows is immigration and emigration by state overlaid against what we call the tax climate. So low tax states versus high tax states. And you'll see a lot of similar charts, but very often you see immigration and emigration by number of people. And what we've done here is not use that, but instead we use adjusted gross income moving in or out of these respective states. So think about the hedge fund guy moving from New York to Florida, one person moving, but taking with him or her a significant amount of adjusted gross income that will no longer be taxed in New York and won't be taxed in Florida either because there's no state income tax. So this is a way of showing by adjusted gross income where people are moving out of and where are they moving to. So on the left, you see some names that probably won't surprise you. So the adjusted gross income is leaving California, New Jersey, New York, Connecticut, Maryland. And where is it going? It's going to the names on the right. It's going to low or no income tax states, Nevada, Florida, Arizona. If we were to redo this chart today, my guess is Texas would be way up to the right, given the amount of, especially California, large employers who have moved to Texas. So this is where we were a couple of years ago. What's ahead? The names on the left, their fiscal situation has only gotten worse through COVID. And without a stimulus-related infusion of federal capital, those states will only have a couple of choices. Number one is raise taxes, and number two is cut services, neither of which are very attractive alternatives to people who now have an even greater degree of geographic flexibility. If I don't need to be in New York or California, and I can move to Boise, I can move to Austin, I can move to West Palm Beach. I think some of the trends that we show here are only going to be accelerated going forward. So as real estate investors, when you think about where do I want to put capital, where am I going to get growth, and where am I at risk from an occupancy standpoint, where am I at risk from an NOI standpoint, where am I at risk from a property tax increase standpoint, I think some of these geographic considerations are only going to become more important and really affect the way that capital gets deployed in our industry. Next slide, Joe. All right, so at Green Street, I have to say we're pretty bearish on gateway cities, Boston, New York, and Washington on the East Coast, Seattle, San Francisco, Los Angeles on the West Coast. We think some of these fiscal issues are gigantic, significant, and really a strong headwind. We think the work from home flexibility and the optionality it gives to workers adds another layer to that. And so what I did here is I show Green Street's estimate of what IRRs are going to be for investors in grocery anchored shopping centers across different geographies. And the key takeaway is, if the question is, where can I get the best IRR as a real estate investor who wants to buy grocery anchored shopping centers, the highest returns are going to come in these smaller cities on the left. So the places that are the beneficiaries of work from home, the beneficiaries of low or no tax, the beneficiaries of low housing costs, and in some cases, the beneficiaries as a result of good weather versus bad weather. You know, Raleigh, Durham, Nashville, Salt Lake City, Richmond, Charlotte, Phoenix. You know, these are the places where we think if we had to buy somewhere, this is where we would start our search. And then conversely, on the right side of the chart, you see some of the bigger cities, you see some of the gateway cities. These are the places where we don't think pricing has adjusted appropriately for some of these headwinds we just described. So the key takeaway here is smaller cities we think are going to be real beneficiaries, but we also think that people crave an urban environment. So if you can be in a place like Nashville, have a lot of the benefits of an urban environment without as many of the challenges that you get in a San Francisco or New York, we think that's really compelling and interesting. Next slide, Joe. So this is a similar concept, but cut just a different way. So this is not grocery anchored shopping centers. This is apartments. So what we map here is net operating income growth. Think of it as cash flow growth if you're not a real estate person. So where in the apartment business am I going to get cash flow growth over the next 5 years? And where are the markets where I'm at risk of having my cash flow decline? And you'll see a lot of similar names to the chart I showed you on the last page. New York on the far left, New York City, Houston, Orlando, I'll leave for a second, but San Francisco, San Jose, LA. And then on the right, some of these smaller cities again, Raleigh, Phoenix, Atlanta, Denver. If you go back, Joe, to Houston and Orlando, in the apartment business, we think Houston and Orlando are beneficiaries from a demand standpoint, but some of these markets are always susceptible to new construction. So while we think the economic outlook in Orlando in particular, less the case in Houston as a result of oil, are decent, supply is a concern in those two markets. But anyway, the key takeaway here, again, is smaller cities, apartment NOI growth is going to be better. Bigger cities, gateway cities, more challenging. Next slide, Joe. When we talk about apartments, I think this chart is pretty compelling. There's a lot going on here, but why don't we focus on the yellow line? And that's the home ownership rate in the United States. And through the 90s and the turn of the century, 2000s, the home ownership rate in the United States soared to a record level. And then we had this thing called the Great Financial Crisis. We had a housing bust, and the home ownership rate in the U.S. plummeted back to where it had been in the 90s and the 80s. And then we've seen over the last couple of years a slight uptick. And right now you have this interesting tug of war. You have low interest rates, low mortgage rates saying to younger people, especially, buy houses. Yet you have, especially in the gateway cities, rents which are declining and in some places are plummeting, saying, wow, I can get so much more for my apartment dollar than I could just 7 months ago. Maybe I'll continue to be a renter. So you have this interesting tug of war. But you have some very interesting intersections of demographics, millennials going from their late 20s to their early 30s, getting married, having kids, moving to the suburbs. It's a sort of a cyclical pattern. But then you have some secular changes too. We've had the gateway cities where for 20 years, 25 years, you've had nothing but growth, success. You know, Mike Kirby, who's the founder of Green Street, and I lived in New York City in the mid 80s. And most of the people who work at Green Street are in their early 40s or younger. And for all of their professional careers, gateway cities have been cool, they've been hip, they've been happening, they've been clean, they've been safe. It's the place where young, ambitious people go to have career success. And those people, when Mike and I talk about the 80s in New York City and explain that if you wore a suit, there were places in Midtown Manhattan, including Bryant Park, this beautiful oasis behind the library in the middle of New York City. You didn't go to Bryant Park wearing a suit in 1985 unless you were there to buy heroin or other things that you shouldn't be doing at the risk of your safety during the daylight. And you just think about that environment and where New York City has been for 25 years. What an extraordinary turnaround. But there's no guarantee that they stay that way, that these cities stay that way. And you know, it's important, I think, for those with some experience and some context to help younger people understand that no one said that New York City has to be the center of the world forever. It should be, hopefully it will be, but it might not be. No one ever said that San Francisco permanently gets to be the tech capital of the world when you have places like Austin and Raleigh-Durham and Denver and Salt Lake City picking off talent, becoming places of innovation. So anyway, just to get back to this chart again, home ownership is this really interesting intersection of demographics, of interest rates, of secular and cyclical changes. And anyway, it'll be interesting to watch where that goes over the next couple of years. Next slide, Joe. All right, so now we talk about the office business. So when those who decide where offices are going to be located, there are a variety of different factors. We've talked about two of them. The top bar is, the top row is fiscal health. What's ahead? What's the tax scenario? How antagonistic are some of these cities towards important employers? I might reference Seattle and Amazon as that example. And then the next line, work from home, especially in the tech business, where we've seen a number of pronouncements. Not only are we working from home now, you guys can work from home forever. That changes how office decision-making gets made. And this last line, which I just alluded to, is desirability. And this really wasn't a factor before and is in a level that's as important as we think it is now. But desirability, people have been working for 7 months outside of gateway cities. They've been exposed to a different way of life. They've been able to go out and jog in the park and go to the beach and do the things they want to do in a way that's harder when you're living in New York, San Francisco, Seattle, et cetera. So desirability, we think, is going to become a bigger decision maker when it comes to office. And I think it was there before, but it was in the background. I think now it's much more front and center. And again, when you think about smaller cities like Atlanta, Austin, Nashville, those are going to fare well on this measure of where people want to be, where they want to live, and importantly, where office using companies are going to locate their offices and their people. Next slide, Joe. All right, and this is my last slide, and then we'll go to Q&A. But what we show here is supply, so the amount of new construction. When the real estate party ends or has ended historically, it's rarely, if never, been a result of absence of demand. It's almost always been we screwed it up again by building too much stuff. But this time it may be different. When you look at these traditional property types on the left, apartments, industrial, malls, office, grocery anchored shopping centers, and hotels, the amount of new construction taking place for apartments and industrial is probably about right. In the mall business, virtually no one's building a new mall. You see the amount of office development way down compared to where it's been historically. Grocery anchored shopping centers, same story. Hotels, volumes of new construction way lower than they've been historically. You've got this one in the middle, manufactured homes. We won't talk about it a lot, but manufactured homes are communities where the owner owns the land, and then people bring their manufactured homes and they rent sites from the manufactured home community owner. It's maybe the best real estate business in the history of real estate. The reason being that as the owner of the community, you own the appreciating asset, you own the land, and other people own the depreciating asset, these manufactured homes. It's a fantastic business. Happy to talk about it more if people want. And then when we get to the right, we see a couple of property types where there is a lot of new construction taking place: self-storage, student housing, and senior housing. So you see a lot of new development going on relative to these other property types on the left. But each of those property types has a story where you can say that's probably appropriate. Self-storage continues to drive new adopters and people who are using storage for the first time. We need more self-storage. Student housing. These are a lot of big university locations where the dormitory alternative is pretty poor. And what developers are doing is building better student housing that's much more apartment-like and it's much better experience for the students than the traditional dormitory. And senior housing, you just point to demographics. More people are getting older, and that's a wave that is going to continue for many years to come as the baby boomers continue to age. We need more senior housing. And so when you see a lot of development taking place there, you certainly have to ask the question, is it too much? But I think there's a reason to not be too afraid. So anyway, the key takeaway here is that new supply always blows up the real estate party, but it doesn't look like it's going to this time around. And with that, Joe, why don't I hand it off to you for questions?
Okay, thank you very much, Jim, for a very insightful overview of a rapidly changing market before COVID, and COVID's only served to accelerate some of these changes. So I'm fascinated by some of your graphs, or maybe I should say the graphs that Stephen put together for you on your behalf.
More accurate, yep.
So I just want to walk through some of them, ask you a few questions, and then I'll turn it over to the attendees for their questions for you. And so I want to go back to where you started, which is to say that essentially the core real estate property types, retail, office, residential, and industrial, have shrunk over the years substantially. And there's a new class of what some people would refer to as non-core real estate, occupying a significant percentage of the index, approximately 60%, I think it is, last time I looked. You talked a little bit about cell towers being perhaps a peculiarity of the tax code, given that some people look at them really as telecommunication companies. But is this shift away from core to non-core kind of happenstance, or something, do you think, more fundamental with the way that the public markets view commercial real estate?
Yeah, I think it's a great question. And a way that I would answer that is that over the last 30 years in commercial real estate, we saw a real maturing of the way that capital gets raised and how it gets priced. So we've seen the REIT industry go from something really small to something really big. So public real estate companies have become a big thing. We saw the emergence of the CMBS, the commercial mortgage-backed security market, providing a really efficient, well-priced alternative on the debt side of the equation. So we saw this maturation of capital. We saw the cost of capital in real estate drop pretty significantly. And as a consequence, you saw a lot of investors have access to capital in a way that made them very competitive when they went out and tried to buy traditional real estate. And so when high quality malls, office buildings in New York, apartment portfolios, high quality hotels, warehouses, when those came up to market, there was no shortage of well-capitalized players in those auction tents. Access to capital has rarely been an issue. 07, 08, 09, 08 and 09 an exception, but no shortage of capital. And so to be a winner you had to bring some sort of competitive advantage to outbid the 20 other bidders you were fighting to buy that property against. And I think some of the capital got frustrated at coming in 3rd, 5th, 12th, 20th in the yesterday's auction. And the capital started saying, well, where else in real estate can we look where the auction tents are less crowded? And I think some of that capital started to gravitate to property types that had a little bit of hair on them. So healthcare real estate, gee, some of the revenue there comes from Medicaid and Medicare. That's complicated. I don't understand it. I'm going to stay away. Or self-storage. Yeah, it's sort of a real estate business, but it's a consumer product, operationally intensive business. I'm going to stay away from self-storage. Data centers, 100,000 foot data center today, maybe 5 years from now, that'll be completely obsolete as that same amount of computing power gets done by a box the size of a refrigerator. I don't understand technology, so I'm going to stay with. But some of this capital started showing up and saying, hey, I can get better returns. And when I do the work to understand the real risk versus the perceived risk of these property types, I think I can get a better, and in some cases, a much better risk-adjusted return. And that capital started flowing to healthcare, self-storage, net lease, data centers, towers, more recently to life science, to single-family rental. Very recently, a big marina deal. And I think, if you're a fiduciary of real estate capital, it's your responsibility to invest your capital and your investors' capital in a way that provides you the best risk-adjusted return. And sometimes that's geographic decisions, sometimes that's property type decision making. And so it's a long-winded way to say I think there was more capital than there was opportunity. And so that capital started gravitating to other places. And that capital, in many cases, found great success, which in turn has attracted even more capital because some of the hair has been chopped off these property types, and people have a higher level of confidence that they're not going to lose their money if they get involved.
Thank you for that. But is another way to say all that, Jim, that, and you mentioned this before, that in the core property types, oftentimes the leaders in those segments are best in breed or pretty damn close to it. So the only way, not the only way, but one of the ways that you can expand the menu, the way you can bring a company to market is not compete directly with the best in breed, but bring a new property type, if you will, or at least an unproven property type with regard to the public market, via IPO or otherwise. And that's part of the reason why we see the emergence of these non-core real estate sectors.
Yeah, I think you have the courage and the foresight and maybe the competitive advantage to tackle these investments, and then you build great operating companies in some cases, and great portfolios in others, and in some cases great real estate portfolios that are attached to great platforms, and you prove quarter over quarter, year over year, that the perceived risk is actually greater than the real risk. And then you have a chance to bring your company public. Cold storage is a great example. The cold storage business, which are these warehouses that are filled with high quality freezer equipment. It's where all the food that ends up in grocery stores, in restaurants, cafeterias, it's where all that food spends at least a little bit of its time. That used to be a very fragmented mom and pop business. And about 5 years ago, two well-capitalized parties started consolidating the business. And now those two entities own 70% of the high-quality cold storage facilities in the United States. One of those companies is public, the other is private. And I think there's a clamoring among capital to try to get in that business today. But because of the market share those two players have, there's very little left to do. So capital coming in today arguably missed the mark. So it definitely requires courage. It definitely requires foresight. It requires a competitive advantage. But when you execute appropriately, to put it in financial terms, when these two companies were aggregating these portfolios, they were paying 8 to 10 times multiples to acquire these assets. And today they're valued in the high teens into the low 20s. So enormous value creation through that process.
Yeah, no doubt. Thank you for that. And before we leave this particular slide, do you have a sense of which sectors might join the list in terms of being significant sectors? You've mentioned two of them already, cold storage just a moment ago, and then earlier life science buildings. Are those the two that sort of seem like they're the next on the list to blow
Yeah,
up is too strong a word, but to increase market share?
yeah, I can't overstate life science. So we have one incredibly well-run company in the public domain. We used to have a second one, but Blackstone took that company private. Blackstone is re-engineering the capitalization of that company now. We have a couple of healthcare REITs that are significant players in life science, one of whom just said this week, we're going to get out of senior housing and we're going to redeploy that capital into life science. So making a huge bet on where the puck is going to be. And we see an enormous amount of private capital trying to get into life science. And then lastly, we've seen some traditional office players whose office portfolios are challenged by work from home and other factors, say that one of their strategies will be to convert some of their traditional office space into life science space, and they're getting into the game. So life science is absolutely a name that fits the mold you just described. And then single family rental is the other. There are about 15 million homes in the United States that are owned by someone and rented to somebody else. That used to be a mom and pop business. It was very rare to find an investor who owned more than 100 properties. And today we have two public companies that own upwards of 100,000 homes each. They will continue to get larger. We have a number of smaller players in the private world that own portfolios of 1,000 to 5,000 units that will be consolidated. Some of those will be public companies at some point. Single family rental, huge beneficiary of a work from home environment. And as a consequence is a name that I would add to this list, given the description you just outlined.
Thank you. Move to the next chart. And I love this chart. It comes out once a week from Green Street, and it, to show you how geeky I am, it's one of the highlights of the week for me. I just love to look at this chart over and over again. So a couple things jump out at me. One of them is the disparity in the discount for the sort of the traditional multifamily apartment sector versus both student housing and single family rental, right? So in other words, the discount for multifamily traditional apartment complexes is almost double what it is for single family rentals and student housing, excuse me. Do you have an explanation? My hesitancy is we all need to live somewhere, and I'm surprised that traditional apartments have been hit so hard relative to the other two.
My short answer is I can explain pretty confidently every bar on this chart, except for apartments. Apartments have been hit in a way that is hard to explain, and hit in a way that has caused us in our recommendations to recommend an overweight in the apartment sector. If you tell a private apartment owner, hey, the public market's saying your portfolio is down 30% since February, I would guess that most private apartment owners would laugh at you and say, hey, we're down a little, maybe 5%, maybe 10, but we're certainly not down 30. And that's what the public market is saying. To take the other side of it, the apartment REITs own a lot of high quality assets in the gateway cities. And those are the apartment REITs that have been hit particularly hard. The apartment REITs that own primarily in Sunbelt have done very, on a relative basis, have done well. They've still done poor on an absolute basis. And when you turn the clock back to February or March, okay, we're going to lock down, people are going to lose their jobs. What's the first thing they're not going to be able to pay? They're not going to be able to pay their rent. So that was bad. But then, hey, these stimulus checks and these extended unemployment benefits, okay, they'll have the money to pay the rent. And they did at a much higher level than we thought originally. But then many months in, those checks are waning and starting to end. And people are having to make decisions. Do I pay my rent or not? If they're living in urban environments and living in little apartments that they pay $3,000, $4,000, $5,000 a month for, do they need to do that? Or can they move in with mom and dad for a couple of months, save some money, and then figure out what they're going to do geographically and from a style of living, own a home, rent a home, or live in an apartment? So apartments, all of that said, apartments have fallen in the public market in a way that's hard to explain. And the fundamentals in apartments, especially in the gateway cities, continue to weaken. And in New York and San Francisco, rents are plummeting. So maybe there's more bad news ahead. There is more bad news ahead. The question we always ask is it priced into the stock? For a lot of these property types, we'd say, yeah, the good and the bad is priced in. For apartments, our conclusion is the market's been too punitive.
So just a shout out to some Booth students. So every year I run something called the Real Estate Lab in the fall of each academic year. And I asked the students to put together a real estate investment strategy that they can execute through the public markets. Last year, one of the student teams came up with the idea of let's short the gateway markets by shorting the apartment REITs that have a coastal, predominantly coastal portfolio, and let's go long the apartment REITs that have primarily kind of a middle America, Sunbelt kind of portfolio. I haven't checked it for a while, but I think that trade looks pretty good. What do you think, Jim?
Yeah, if you'd gone long Sunbelt and short gateway and apartments, you would have done great.
Yeah, I don't know if anybody putting money down. It was an academic exercise, but at least on paper, it turned out pretty well. The other thing that jumps off the page to me is that malls and strip centers pretty much are trading at the same discount to where they were before the COVID pandemic hit prices. And it's surprising to some of us in the sense that when you hear about retailer bankruptcies, they seem to be primarily tenants in malls as opposed to the grocery anchored strip shopping centers that we're more, perhaps most of us are more familiar with. What do you think about that, Jim?
Yeah, this one's a little bit nuanced. So this is what's happening. This is what's happened to real estate owned by the public companies that we cover. And that's important, especially in the mall business, because there used to be a lot of mall companies. Now there's fewer. And there were some mall companies that owned malls that were of lower quality. And in fact, earlier this week, 2 of those companies declared bankruptcy. So the mall statistics that you see on this page are not those companies and not those properties. It's the much stronger and higher quality malls that are going to have to evolve and change, but have a very high probability of surviving, unlike some of the malls owned by the companies that just went bankrupt. So that there's a little bit of subtlety there, in that the malls represented here is in large part, maybe the top half, maybe even the top third of the mall business from a quality standpoint. And then the strip center portfolios are more representative of what's out there in the private market. So yeah, the challenges of all these small tenants in these grocery anchored shopping centers. For a grocery anchored shopping center, the first question is, who's your grocer? How well are they positioned? Are they going to stay in business? Because it's the grocer that attracts everyone that comes to the center. And then while they're at the center, they go to the dry cleaner, they go to the nail salon, they go to the barber shop, they go to the Subway sandwich place. A lot of those tenants have really struggled. So, unlike the mall business, where there's definitely a concentration in the highest quality assets, the strip center REITs own high quality assets, but a bit more representative of what's out there. So, if I understand your question, if we included all the malls, that bar on the right would be much lower, but it's a subset of the mall business, and it's the really high quality malls as opposed to the entire industry.
Understood. Do you think that another part of the explanation, though, might be that pre-COVID, the malls were already being adversely repriced?
Yeah, that's a great point. Mall companies had already been crushed from a share price standpoint, so they had already fallen a lot. So that's an argument they had less far to fall versus the strip center REITs, which were in pretty good shape pre-COVID, but really got hit as a result of COVID and concerns about some of these smaller tenants and whether they would survive not having much or any business for a couple of months.
And I guess the last point I want to make, and this is some dialogue that you and I and some of your other Green Street colleagues have talked about in the past. One of the things that jumps off the page with regard to the performance of the sectors on the left-hand side, data centers, self-storage, cold storage, towers, industrial to some extent, is there almost no people in those real estate types, right? So in other words, we have this weird situation where returns on a relative basis are going up as a function of the number of people who visit your property are going down. Kind of turns on its head the whole way we think about real estate, right? Developers like to talk about these gauzy adjectives, walkability, the built environment, and all the rest. And none of that really has to do with how, at least during the pandemic, these forms of more or less digital real estate have held up far, far better than more traditional types of real estate, whether they're core or not core. A thought about people versus returns? And is it temporary, and will it reverse itself once we finally get away from this COVID pandemic? Sorry.
Yeah, the facts speak for themselves. If you're in a real estate property type that doesn't intersect with a lot of people, you've done well. The names on the sectors on the left, and if you are a real estate sector that requires a lot of people, office, mall, and hotels, you've done poorly. So those factors speak for themselves. The tougher question is what happens post-COVID.
Right.
And I mentioned the office business before. If you listen to some of the REITs on their earnings calls who own New York City office completely, and that's their portfolio, you'll hear a lot of enthusiasm as it relates to a vaccine, and how once we have a vaccine, people will be back to the office and New York will thrive once again. That's one argument. The other argument is that people have had 7 months, and by the time we have a vaccine, maybe 12 months of working in a different type of structure and environment. How ready will they be to go back to the office? And financial services, which is a dominant employer in New York, maybe you have a different answer than you have in, say, San Francisco, where tech is a dominant employer, and the tech companies have been much more aggressive at telling people you can work from home for a very long time. So office is the place where I think the greatest debate will occur. But undoubtedly, in a recovering environment, places that people gravitate to are going to do better at some point than they've done on the chart that we show here, and convert. It's hard to argue against data centers and cell towers and the demand drivers there. I don't think you need COVID or absence of COVID for those property types to thrive, but there definitely are some subsectors here, particularly on the right side, where you need to be thoughtful. Even lodging, right? Hotels were literally closed. Their occupancies are on average something in the 30 or 40% range on average, which is better than where they were a few months ago in the teens, but a far cry from the mid 70% occupancy rate that you typically see in hotels. What are business travelers going to do post-vaccine? I used to travel to New York 6 times a year from Southern California, where I am right now. Do I need to go 6 times a year, or can I do 5 trips and a Zoom call? Can I do 4 trips and some Zoom calls? I think business travel and what happens to business travel in a recovery is really fair to question, because we just now have this other way of communicating that in February, if you told me we'd be on a call like this, I would have laughed at you. I don't even know how to turn on my laptop. How am I going to conduct this call? And here we are. So people, sure, when we have a vaccine and people can intersect again, these sectors will do better. But have we changed in a secular way the way people think about office, how they think about shopping, how they think about hotel usage, et cetera?
We're getting close to the top of the hour, and I want to be respectful of everybody's time. So let me ask John, do you want me to continue, John, or do you want to ask a few questions raised by the audience before we shut her down in about 5 minutes?
Yeah, thank you, Professor Pagliari. Actually, there's two questions here that I wanted to just throw out from the crowd here, from the attendees, and one of them was kind of following up on what you were just talking about there, Jim. You were talking about offices, and then going into, you were kind of touching on lodging to a bit, and they were asking, looking at slide 3, if private valuations follow public pricing for lodging in 2021, how quickly do the private valuations turn around if public health environment improves? Does it take another year or longer? What's your estimate?
Yeah, I think, I don't have the numbers in front of me, but I think our hotel analyst, his name is Lucas Hartwich, he's very talented. I think for hotels, he doesn't have cash flow for hotels in aggregate getting back to 19 levels until 2024. So we have this giant dip in 20, get a little bit of recovery, we get an acceleration of recovery as we get into 22, 23. But I believe his cash flow figures and forecasts don't get you back to 19 levels until 2024. So, and that's not to say the stocks and private market values will wait until that happens. The public market certainly tends to be forward-looking. Private buyers looking for opportunities, get their best deals when things are darkest, not when they're brightest. So we may see private market values and public market values move in hotels before really strong evidence that things are recovering. But I do caution that we may have, given that business travel is about 70% of the revenue of the industry, or at least for institutional quality hotels, how is business travel going to change going forward versus where it's been in the past? And I think that's a really important question, and a lot of people have different views on that, the answer to that question.
Great, thank you. And I'll see if I can get 2 more questions in here before we have to sign off here. Another question that comes in, the future of trophy offices seems like a serious headwind for core allocations. How should institutional investors reallocate effectively from large ticket tier 1 markets into non-core?
As we talked about, we think Gateway is challenged. The REIT CEOs and C-suite executives of the New York City office REITs totally disagree with us. So that's fun. That's a source of a robust debate. If I were advising institutional capital, which I did for many years at Green Street on exactly this question, where should I go and how should I invest? My recommendation would be you want to take chips off the table in Gateway tier 1 office, and you want to reallocate it elsewhere and not necessarily into office. Office is a challenged business compared to some other property types, not only in Gateway, but in suburban locations. So I think that's an important question. Do you need to be in office at all? But the challenge to executing on that strategy is, what's the bid for your tier 1 office? We've seen very few transactions. The successful transactions have typically been buildings with a long-term lease with an impressive credit tenant. Those are partly real estate, but they're very bond-like investments when you really cut through it. Those have traded, they've done well, having a lot to do with absence of yield in the bond market and elsewhere. But your traditional multi-tenant tier 1 office building, especially if it's in a part of town like 6th Avenue in New York, where tenants were already relocating from to go other places in New York, the Far West Side in particular. I could tell you what I would do if on a whiteboard, but executing, because what's the bid for that tier 1 office is probably not very robust right now. So the strategy is easy, the execution is much harder.
Great, thank you. And we are almost out of time. If you have time for one more question, I'll be happy to field that. Otherwise, you let us.
Yeah, I'll take one more, John.
Okay, so this is more of a entrepreneurial booth question. I would add. So for those attempting to start a CRE platform today or in the next 3 to 5 years, what are your tips for best practices? What have you seen from those who have been successful in these types of endeavors?
Yeah, if I were a student coming out of business school, I would try like heck to align myself with a big established shop to learn the trade and to learn how to do it. But while I'm doing that, I would focus on integrity. We're in a business that is a highly compensated business. There's a lot of money to be made. And unfortunately, that money sometimes causes people's moral compass to break. And, it's great to make a lot of money, but my advice to students is find a way to do it with integrity so that you can look yourself in the eye and be proud of what you've accomplished. So that's number one. So number two, I would say that I would try to find a place that has some specialization in these niche property types. Get with an organization where the capital is being invested in places that are far less crowded than true commodity real estate like apartments or office. That's not to say that you can't learn a heck of a lot in apartments or office, or have a very successful standalone platform in those property types. But I think the real opportunities come in some of these niche property types that are less crowded from a capital standpoint, a competitive standpoint, and where smart, ambitious people can really foster true competitive advantage and really be better than the next guy, and then take that competitive advantage and go find institutional capital to fund your deals. That would be my recommendation. But we just see too many examples in our industry of people not adhering to the integrity comment. So please take that to heart and keep your guard up when you see people who are doing things that just don't seem right, even though it could result in a nice payday.
Excellent. Well, thank you very much for your time, Professor Pagliari. Jim.
Yeah, I just want to say in closing, thank you very much, Jim. I think it's evident to everybody on this call as to why Green Street is considered the preeminent real estate, just not REIT, real estate research shop around. And for those who don't know, Mike Kirby is a Booth alum, and I think you can see a lot of the business principles and ethics, to Jim's point, with regard to the wonderful research that Green Street pumps out almost on a daily basis. So again, Jim, thank you very much for your time and your insights.
My pleasure. Thanks for having me, and I hope I provided some interesting food for thought for people in the audience. And if I think you're going to put up a slide that has a link to these slides. So if people want to get a copy of the slides, just reach out to our marketing folks at through this link. And if you have any, I see there's some additional questions that we didn't get to. If you want to shoot me an email, I'll be sure to get back to you and give you an answer to your question. I apologize, we couldn't get to them all. The ones that were asked were really good, and there's some that we didn't get to that are really good as well. So just shoot me an email and I'll get back to you. And thank you to Joe, and thanks to the University of Chicago for asking me to participate in this. And I really appreciate everyone getting involved, asking good questions, and I wish you well.
Thanks again, Jim. Much appreciated.
Thank you. Who was the call today? Thank you.